All right, all right. Well, let's go ahead and get started, everybody. So, all I first of all, I'd like to say welcome to all the future investors. We have investors here from overseas. We have them from local, our backyard here in DC, the West Coast. We even have some people here from Tokyo. So, first of all, I'd like to thank everyone for jumping on tonight. So, tonight we're going to be talking about DealMakers Bank International, and specifically, we're going to be talking about our reserve investor opportunity. So, the purpose of today's webinar is three things. First and foremost, we are looking for reserve investors. And because we're looking to raise capital, we're looking to get some soft commitments as well. So, we're giving you guys early access because of the people that I know, the Curtises, the Jans, the Alexanders, whoever, invited you guys, whether it's through your advisory services or investment banker, however you got on this webinar. We're looking before we launch our full campaign, which will be on the 20. We're launching on the 28th of May. You guys can get early access to it, and also you can kind of reserve your spot as well if this is something that you guys are looking, that you're open to or looking to invest in. Secondly, we're looking to prime the market, so spread awareness about what we're doing, because just because just in case this opportunity doesn't work for you for whatever reason, it might be not every investment opportunity is for every investor. If you are a builder, if you are a investor, if you are you know active in deal making period, you should become a client of ours. So we're looking to definitely spread awareness, prime the market, and thirdly, we're looking to get feedback about our investment opportunity from investors. So what to expect from today's webinar? First of all, if you could see our vision, you could see our 5 to 3 plus year vision on what we're looking to build for deal makers. Secondly, you get to a deeper understanding about our risk-free opportunity as a reserve investor. And then, of course, at the end, we'll have a Q&A session. So you get to ask questions and we can go a little bit deeper into that. All right. So who am I? My name is Sir Derek Fantomov. I'm a financier and deal maker. That's realistically just a fancy way of saying that I raise and provide capital to companies and I negotiate mergers and acquisitions. Now, I've been in finance for about 2 decades now. I started in 2009, and along with my best friend, who's now my lovely wife, and we ended up becoming one of the youngest regional vice presidents of our company. We ended up establishing two branches here in DC, as well as we ended up establishing over $2 billion of life insurance policies with a agency of about 80 plus agents. After we sold that business, I ended up getting into deal making. So I have about a decade of deal maker experience, and I ended up jumping into being a loan broker, and then naturally progressing into being a deal maker over time and working on a couple different deals. I've worked on over $3.5 billion worth of deals over the last 10 years, all independently from working with any Wall Street firm, directly working under them. But I've worked with a lot of Wall Street firms. I've almost raised about $1 billion as well, mostly debt and some equity. It's about $884 million to date. And hopefully, in the next, so with this year and next year, that can cross well over $1 billion. And I haven't just worked domestically, but I've also worked internationally as well. And I have about 25 plus years of entrepreneurial experience. I had started my first business at 8 when my parents taught me the concept of money by making me, start a little candy business. Then that evolved to me and my mom having a clothing store. And then later on, I ended up having a video game store, and then end up starting to do like team parties and being a small party promoter, and then eventually moving to DC, and then I'm jumping into finance at 19. So let's dive into it. What is the problem? So the problem in deal making, the problems for deal makers in the traditional space is banks lack creativity. Most banks lack understanding and the mindset to truly, truly, truly help deal makers navigate and close more deals. I if anyone here has ever bought a business or bought a property that they was going to, like an investment property, or try to develop something, the last place you're going to go to is a traditional bank. It's because they just don't have the creative flexibility to do a deal. And you have to really build relationships with them over time, and even still, that has a lot of limits to it. Secondly is speed. Now, most of us understand that speed is king. In deal making, speed is king. Because I will tell you this, 90% of the deals that I have lost has not come from not like someone outbidding me. Most of the time I overpay for deals because I'm looking for a particular structure, but it is speed. Most of the times, like that is the reason, like myself, my clients, just other things I've seen, is that like if someone can, you know, close quicker than you can, they're not something going to get the deal unless you really built rapport and or you really overpaying. That's that's really the only time that you tend to beat speed. And then lastly is rigid framework. I mean, after the, subprime mortgage crisis, you had a lot of banks that the regulators tightened up so much that it ended up strangling a lot of banks. That's why you start seeing a lot of banks start merging with each other, or you had a lot of banks that for some reason, like they're just not lending, or their lending criteria is just crazy. And even when you meet it, they might still deny you everything. It's because of the rigid framework. And when you're a deal maker, it is incredibly hard to get traditional funding for acquisitions or for creative structures. So those three things are like the major problems in deal making. Now, how does this impact deal makers themselves? Now, I want to give an example here of a company of a company I had last year. So ABD Oil Services was a company that I was consulting with. Now, they had the opportunity to buy a smaller company that would increase their revenues by 60%. So they was in the phase where they're going to start growing by acquisition. Now, they had been doing, they've been building rapport with the seller. I mean, no one, I mean, they were the only buyers that were looking to buy this particular business. So of course they didn't really need to get it on the contract because no one was really looking to buy the deal. So they were starting to underwrite it with a local bank. They was going to do a transact like a normal transaction. Well, then out of nowhere, a competitor came and was like, "Hey, we want to buy you, and we're going to put down $1.5 million." So which was a lot more than what my client had, to put up for earnest money. So what they end up doing is they end up going to the the bank that was underwriting the deal, asking them if they could front them, let's say $1.5 million, $2 million, in order to put down this earnest money. And they had it structured to where they're basically not going to lose. They wouldn't lose out on the earnest money. It never goes hard. But the banks, again, rigid frameworks, lack of creativity. And so they denied them because they said that, hey, if we were to extend you this loan, we have to then start the underwriting process all over again, and all this hoopla. And so what ended up happening is that they just couldn't do it. And then unfortunately they ended up losing the deal because with the competitor putting up $1.5 million of earnest money, I mean it I mean rightfully so, even though they've built up a lot of rapport with the seller. Hey, someone's looking to drop $1.5 million in earnest money is pretty attractive. My apologies. So yeah, so they basically end up getting on the contract and they end up losing the deal. Now it took that other company like 6 months to close on the deal, but again, they was able to move quickly, have put some money up, and then and then eventually they were able to close. So again, that goes back to speed. Speed is king. So that right there was like what really got me thinking of, like, okay, we need to build a bank for deal makers, by deal makers. We seriously need a solution, a traditional solution for deal makers. And that's where Deal Makers Bank International comes in. So, what is DMBI? Well, our mission for DMBI, so building that bank, is to build a bank that caters only to deal makers, to help them successfully close more deals by providing them what I think is most crucial capital, in deal making, which is the launchpad capital. Now, our 5-year vision is to help, is to establish 5,000 core deal makers in our ecosystem that could close, at a minimum $3 million a year, or just say on average $3 million, probably a minimum of $1 million a year. But something like that, we'd be a major player. We'd be a major player in this space, and also this place is it's a blue ocean. There are no other banks, no other like legitimate banks that are in this space. What is our product? We are providing deal makers with a launchpad line of credit. Basically, what this is a line of credit that they can draw upon to do one, two, or all three of the following transactions. You have transactional funding, or table funding for some people, and that's typically used for double closes in real estate, but you can use it in business acquisitions. You can actually get really creative in order to be able to extract and pull out capital or pull out equity in a business or from different assets. By using double closes, you can access actually more funds. Secondly, we have escrow financing. Now, this right here is something that my wife and I have been doing for the last couple years. I would say probably the last 3 years, it's become kind of a known thing, like in the real estate space, where you can finance someone's escrow. But it's not really a thing in the business realm. So there's a blue ocean there as well. But then there's a lot of opportunity for escrow funding in real estate as well. And then lastly, you have gap funding. So gap funding, everyone knows that right there is going to be, that right there is going to be a game changer, because people people always need some type of gap funding, or at least there are probably 8 to 9 transactions need some type of gap funding. So that right there, we've gotten a tremendous amount of positive feedback, a tremendous amount of interest in this as well. And really all of these products, especially in escrow and the gap funding. Now, some use cases. Now, last year I ended up having a client that ended up getting a property under contract for $300,000, and then they also had a buyer that was willing to buy for 380. So he had an $80,000 like equity in the deal. So he came to me to put together, $300,000 for him. So we ended up providing him the funds. He ended up making 75,000 because we ended up charging 5,000 in order to put the deal together. Then you also have escrow funding. So I had a client last year that we were looking to buy. Well, we were buying a portfolio for him. So it was a $15 million portfolio of a couple properties here in DC. And now that had some competition to it. So this is where that they, basically the where a lot of deal makers would use us. So we ended up negotiating a 15% earnest money deposit. So it's about $2.25 million, so that we can get on the contract and we can start the underwriting. Also, we had some creative terms that we were trying to get from them. So putting down more money just made them more open to it as well. So we was able to do that. And then lastly, they end up turning around and needing some gap funding, because the lender at the last minute, instead of giving us an 80% loan to value, they end up giving us 70%. So we had to end up raising another $1.5 million in gap So, and we did that for a 12 to 24-month term. So there's a tremendous amount of opportunity out here, and these are just small scale examples. There are a lot. There are very large examples that I could give you, but I think that this right here was good use cases because it's small enough to for to get your head wrapped around it. So how are we going to source deal flow? Now, our secret weapon is going to be our Deal Makers Banking Club. So that is a paid invite only community where we're actually teaching deal makers, teaching people how to become deal makers. We're giving experienced deal makers or even like new and experienced deal makers the opportunity to learn more, work together. So build a community of deal makers so that they can, work together, bring deals to each other, workshop deals, raise capital, all that beautiful jazz. So we think that this right here is going to be a where we're going to get our 5,000 core deal makers from and beyond, where we're going to get a lot of deals from anyway. So with that, we believe that our we project that our numbers from the interest that we've already gotten, we project that our numbers are going to be 12 million in revenue the first year, 24 million the second year, and up to 40 million within the third year. And this right here is what we consider the plan period. So it's the de novo period of our bank, and then we're looking to also build. We think we're going to be able to build a asset portfolio of 30 million the first year, at 89 million the second year, and up to $290 million the third year. Now, of course, these numbers are all very high level numbers and everything, but when you go into the data room, if you're not just watching this in the data room, you can actually go and take a look at our pro forma and really see how we got these numbers. And these numbers are supported by the traction that we're currently getting. So I end up running a small word of mouth campaign through some of the professional groups that we work with. We just ask them like, hey, can I do a post saying that, hey, we're looking to start a bank that's doing XYZ, it's for deal makers, and this is what we're looking to do. Just very high level stuff. And we end up getting 44,000 pre-signups. So a large we have a large interest. So, that right there is telling us telling us the market is telling us that, hey, we're interested in this. You need to provide this to us right now. Now, also last week we ended up crossing $100 million in pre-signups from professional investor groups for our Launchpad line of credit product for groups. So that's a minimum $5 million, line of credit that we would issue for them. Now, and then of course we have Deal Makers Banking Club. We end up having, a 200 inquiries. We haven't launched it fully yet, but so far with about 200 inquiries, we believe that's going to grow over time. And then we also have a marketing plan to grow that as well. But then the most important traction that we have is the regulatory traction, because at the end of the day, if we have not talked to any regulators, if we're just starting from scratch, then all this other stuff is mute. So I've been working with since November of 2024. I've been working with the regulators down there in the jurisdiction we're looking to get the license from. I've been working with them on our business plan, our numbers, the concept, everything, and they absolutely love it. They like the idea of it being a business focused bank. They like the numbers of like having the amount of clients lower. They love the product. They love the product idea. So, and they're asking us like, hey, when are you going to apply for a banking license? You should apply in the next, 45, 60 days, so that's kind of like the timeline that our coordinator has been working with us to lock down. And let's talk about our team. So you have me, Sir Derek, and then of course you have my lovely wife, lady. She has, she has 16 years of financial service experience and marketing experience as well. After we sold our first business, see, I went into loan to being a loan broker and a financier, and she ended up starting a firm that was a private label marketing firm. So her clients were other marketing firms whose clients were Fortune 500 and 5,000 companies, and just around the world. So they've done amazing things. So we're lucky to have her on the team because she can come up with a lot of creative campaigns at a very, very good cost. You have a partner of mine that I've been working with for years, Curtis. He is a business developer as well as a deal maker, and his specialty is real estate, large scale real estate development. So he's worked on, you know, large planned urban developments, large sky like urban developments, and a couple data centers he has under his belt. And then you have Jan Lamb. Jan Lamb, we've been working together for the last year. We've worked on a couple deals in North Carolina. I mean, he's a phenomenal guy. He's an educator. He has a group. He was one of the first people to sign up for our group line of credit, and we kind of helped, we kind of create the concept, with his help, everything. So we have a couple more team members. This right here is our core team right here. So let's talk about the opportunity. Let's talk about what is a reserve investor. So I've gotten this question, I've given the technical answers, I've given the long answers. So I want to be able to give the most concise answer as possible. So, a reserve investor for us is an investor who is basically a liquidity provider or someone who is providing us proof of funds from their bank account. So, what that is that so in banking, there are two tiers of capital. I mean, there's more than that, but there's basically two tiers of capital. You have your tier one capital, and then you have your tier two. Your tier one capital is like your liquid cash, like your cash on hand, right? Sometimes there's also U.S. Treasuries, and then your tier two capital is like equity, so like your investments that are paying out. You have your supporting debt. You have like investments like bonds and things like that, right? So when it comes down to the bank examiners examining your bank every year, and when it comes down to underwriting, the first thing that they're going to look at is your tier one capital. Because at the end of the day, your tier one capital is the most important capital. That's the capital that, like, hey, if everything go to hell in the handbasket, meaning your portfolio, however you have it, however you have your portfolio, how much cash do you have on hand? So if you take deposits, you need to have a certain amount of cash on hand to service those deposits. If you have investments, you need to have a certain amount of cash on hand to cover operations and withdrawals in case that portfolio stops performing. You have these things where, like, you have these things where, as a bank, you need to make sure that you keep a certain level of liquidity. So for us, if we're looking at about 10%, is what we're looking to stay within. So as a reserve investor, we're looking for investors who have high liquidity, who have liquid cash that's sitting in an account that they want to earn interest from, right? That they now, of course, sitting account also means unencumbered as well. So, and the reason why is so that when we go out there and we get our bank exam, we have our bank examination, and or we're going after, let's say, establishing our line of credit to then start issuing loans and doing all these different transactions, the underwriters and the examiners need to look at our tier one capital. So that's essentially what we're looking for. We're looking for people or shareholders that have high liquidity, that can keep money in their bank account. In a custody account, probably a sub account that they will create in at their bank, and they need to hold those funds in liquid cash for a minimum of 3 years. And what we're doing with this is that we are paying 10% per year for to these reserve investors. And of course, because you're a legal shareholder, if we take any distributions, you also are legally required. We're legally required to pay out any dividends as well. So you are shareholders. It's just you get to be the custodian over the funds that you're investing. Now, this model is not something that I created. This is a model that I saw. So I'm just taking it. You know, I had a transaction a couple years ago with a Swiss company where they were looking to raise capital for a particular bank that was that basically they had, I'm sorry, not a bank. They had a company that was looking to raise funds for an acquisition, and they were looking to up their equity. So what ended up happening is that they ended up coming up with this concept, and then so them showing the concept of reserve investors, and so that way that they could have the equity in order to facilitate the underwriting to actually be able to get the funds in order to buy the company. Another thing, and I can't disclose the bank that my wife and I bank with, that end up giving us an opportunity to be reserve investors in this one other bank as well. So that we're very familiar with the concept. So that's why I'm just like, at a, you have a high level. Yeah, I'm sorry, you have a very technical review of it. So I just wanted to give you like, hey, this is basically what it is. You are a proof of funds. You're just providing proof of funds for this bank, or for our bank or this company and everything. And that's really how it works. Now, the benefits that these companies have: the borrowing company gets to purchase temporary equity at debt rates, and it doesn't truly dilute themselves. So as a company looking to raise reserve capital, it you know that right there for us allows us to get equity on paper, pay out a debt rate, and then be able to receive our equity back once the contract's done, and the payout, the promised payouts are paid out and everything. And for the reserve investor, well, you guys get the benefit of getting a at market or above market return with zero risk, with absolutely zero risk to your principal. you know and this is, and this right here, and of course you also get distributions. So if there's any distributions, you're legally obligated to get distributions as well, and that does not count towards the interest that's paid out and everything. So I mean, this model, I think, is very unique. We've gotten a lot of great feedback from it. So again, giving you guys early access, we definitely wanted to get some feedback from you guys. If we can also raise capital from you guys, that would be amazing as well. Now, how does this process work? So basically, as a reserve investor, you simply hold liquid cash in a sub account that you created. It could be a checking account, it could be a savings account, it could be a money market account, and in some cases, it can be U.S. Treasuries. But there's like a little bit of paperwork that we have to do for that. Secondly, you guys will provide us with view only access to this account, and of course it must remain unencumbered. So there can't be any UCC filings on those funds. It needs to be completely unencumbered funds. And the reason why is because the regulators and the underwriters, whenever we're getting underwritten by either the Fed or we're getting underwritten by another bank in the interbank markets, they're going to 9 times out of 10 do a SWIFT message to confirm the funds availability. So that's why it's very, very, very important that we have that you have liquid funds and it's unencumbered, because we'll be able to see all that. And one of the benefits as well is that having it in their check-ins, savings, money market accounts, that you get to earn interest on top of that. So we're paying out 10%. That's simply what we're paying out. So if you're able to, through your checking, savings, money market account and whatnot, able to have extra interest, then you get to keep that. That's perfectly fine. And I think that's one of the reasons that make it so attractive to people. Now, I know a lot of you might have heard of SWIFT. Some of you may have not, but SWIFT is basically the Society for Worldwide Interbank Financial Telecommunications. So it's just a messaging system that a lot of international banks use. A lot of domestic banks use it as well, but there's other systems that domestic banks use. But that this is why it's very important to keep. And I know I keep stressing it. It sounds like a broken record, but that is why it's so important to have liquid, unencumbered cash. Um, so now, again, the regulators 9 times out of 10, they will probably in the first 2 years they probably do a 1 to 3 times per year a Swift message to make sure that the funds are there. And for sure, every time we get underwritten by a bank, for getting either loans or anything like that, any borrowings from other banks, they'll also do a Swift message every time. Now, again, I know I kind of already answered the question, but I just wanted to go over it again. How, because most of the times at this stage, people still might be a little confused of like, well, how are you going to be lending money without having our without having the reserve capital in your custody? Well, first of all, you have what's called the capital adequacy ratio. So that is where I know a lot of you all have heard of fractional reserve banking and how banks, hey, for every, if you put $1 in there, they're able to lend out $9. Basically able to create money, out of thin air. How that actually works is that banks have their car, so have their money, their capital, their tier one capital, and then they're able to leverage that 9, 10 times, and it actually go up to more. It can actually realistically go up to 12, depends on, you know, how your balance sheet is basically balanced. So like how your balance sheet is basically structured. So if you don't have deposits, you can actually have a much higher leverage ratio, in which we're not looking to have any deposits. So we will have a much higher ratio, but we will stick at that 10% ratio or leverage ratio. Now, one of the most important things that you have to understand here is that off balance sheet assets. So a line of credit. So if we was to, issue, let's say $1 billion worth of um launchpad capital, like launchpad line of credit, right? If we were to do that, your natural thinking is to think that, oh, if you're issuing $1 billion, you need $100 million of capital. Well, no, that's not the case, because it's technically an off balance sheet asset. So that means it's not considered an asset or a liability until you actually issue a loan or make a transaction, stuff like that. That's where that actually will then come in. And then you have to then look at the counterparty risks, right? So we only have three products. We only have three products that we're doing. We're doing transactional, escrow, and gap funding. So transactional or table funding and escrow financing, those do not really have any counterparty risks. So, table funding or transactional financing, that capital really doesn't leave the ecosystem. You can do, a bank that has zero money can do billions of dollars in transactions if they wanted to, because the only thing they have to do is either wait for the third party buyers cash to come into their bank account, and then they'll send it, or they can just borrow money overnight for the transaction. So that's a nothing burger there. And when it comes down to escrow financing, that's a little different. It can stay in your own ecosystem, but it also depends on, well, okay, are you the escrow agent on this, or are you sending it to another escrow? But again, that's pretty simple as well, because if your contracts having it to where the earnest money is not going to go hard, and so you doing the borrowings, overnight borrowings from either the Fed window or from the interbank markets, that's realistically a nothing burger because you should be charging enough to cover that cost of capital. The only counterparty risk you have is gap funding, you know, and of course, you're making sure that you're keeping those ratios in mind. So the type of assets that you're investing on, and how you structure a deal, and whatnot. And then, of course, we will also be retaining earnings as well. So we'll build up that tier one capital that we have on hand in order to be able to do loans as well, or to leverage and able to service the debt. So what are we asking for? We are asking for $10 million. So now we're looking for $10 million. Now there is a minimum of $500,000 investment. Now, of course, for early access, where in some cases we are allowing it to go down as far as 100,000, but we'll do investments as blocks. For people on this call, whomever sent this to you, you should talk to them about the block and how to buy into that. And again, it won't be in our custody. It will be in either you guys' custody if you have it as a block, or if you put together like a JV agreement and you have a third party service provider like a RIA, so a regional investment advisor, or a wealth manager, kind of manage that. You could set that up, but we're looking at $500,000 blocks, or minimum, minimum blocks. Now let's look at the capital structure. The capital structure is at $1 per share, with a minimum $500,000 purchase of shares and everything. Uh, Interest will be accumulated either through simple interest or compounding interest. It really all depends on if you want distributions every year, or if you want them, if you just want to wait to the end of the term. Now we have a 2 to 3 year a 3 to 5 year option. So you have a minimum 3 years, but we will go all the way up to 5 years, everything. And what you commit to, if by any chance we want to, let's say, pay you out early because we might want to we might actually want to raise some extra, we want to raise some extra equity and whatnot, but we want to kind of take your equity to not dilute ourselves and things like that, then of course we would pay you out early as well. Now we do have an incentive program. So if you were to do a soft commitment before the 28th, because that's when we're launching our official capital raising campaign, then you will automatically receive the 10% compounding interest and everything. So even if you took distributions, we would still like pay you out as a compounded interest. So that way, we're just doing a little bit of incentive, because we are looking to raise capital as well. That's part of why we're doing this webinar. Now, for investors that turn in term sheets after the 10th, you're looking at an 8% compounded interest. Again, that same type of model I just mentioned. Now, let's really talk about the risk factors here, because there are risk factors. Now, there are not risk factors when it comes down to your principal, because again, you're holding that. You're the one that's managing that. But there are risk factors for your returns. So I have to disclose that. Now, first and foremost, I think the biggest risk factor here is the license. Some of you all have capital right now, and you're just like, I want to go ahead and move forward with this, and I want to lock it down. That's great. But there is a chance that, even though the regulators like our business plan and whatnot, but for some reason they just don't issue us the license. For some reason. I don't know why they wouldn't, but let's say if they don't. Well, there's that risk factor that you took cash from wherever you had it at. And we just don't get the license. So the contract's null and void at that point, right? So there's that risk factor. You have a regulatory risk factor. So the regulatory environment, especially with the new administration, you run the risk of the regulatory body or the regulatory framework changing. Now, I think it's probably going to be a lot looser than not, but there could be economic crash that then cause tightness that would then might change how we like how we're structured or how we structure tier one capital and whatnot. So that there's always that risk there. Now, a liquidity commitment risk, that's more of a risk for us. When you actually look at it, that's more of like for you guys, since you have access and custody, you still have custody over your funds, there is still that risk that, hey, you guys might something might come up. Family emergencies happen. I mean, we all have families, so something might happen. So you might need some of that money that you have on reserve, and you need to tap into that. Or you might even have an opportunity that you might think is more exciting. You're just like, I know I committed to this, but I can make more money at this for whatever reason you decide to pull out, to pull some capital out and whatnot. And you might do it when we need to do a swift call. And so that risk is to us because you might have $500,000 committed and you might take $100,000 because you might be doing some type of transaction that you think you're going to get the money back. And then we do a swift call, or the regulators do a swift call, and they hit us with hey, you're under your capital, um you're under your minimum capital requirement and everything. What's going on here? And now we're looking, and now we got to scramble to either figure out what's going on or things like that. So there's that risk, and with that risk, you know that will of course affects how your returns are. The return risk. Now, the return risk, it is a fixed risk. While it's fixed at 8 to 10%, it is a promise, but it's not. But non-performance could affect or delay, or we could have missed payments. If we don't perform, as if we don't perform like we thought. I mean, there's that risk there. Again, no risk to your principal, but just risk to the promised returns. You have bank structure risk. Now, again, the bank could fail. It could be economic reasons of why the bank could fail, and then it's just like you don't receive any of your payments. Everything there's of course that as well. Unlikely because banks have a 2% like failure rate. So even in hard times, I mean their failure rate is very low and whatnot. But I mean, there's still that risk there, and we have to disclose that. And then finally you have custodial risk. So, and this is more technical, this is more of a technical risk. So your bank could either not have view only access, or it does have view only access, but then they might change it for some reason and you don't know. And then we try to get in contact with you, and then you're somewhere in Dubai, you know, living your best life, and we're just not able to get in contact with you. And for a set amount of time, and then we have to we have to go through the process to basically boot you as a investor, and whatnot. So that there's that risk there. I think that's more of a less risk that could happen, but it's still a risk that's there that I've seen people just not think about. So I would rather bring that up just in case something like that was to ever happen. Everything. So those right there are the risk factors of like how you could not get your return. So these are things you have to think about, and make sure that you guys are comfortable with. And then in conclusion, let's kind of going over everything. We're looking for, in liquid investors that are looking for conservative opportunities with high returns. You know, reserve investors have the opportunity to earn 10% for 3 to 5 years risk free due to them having custody and control over their own funds. But, again, you have to maintain liquidity, outside the markets. I know the markets are looking terrible now, but if you're like for true investors, you're like, oh my God, I need to buy into the dip. and who knows if it's going to get worse, and everything and goes lower, and it's kind of like, oh my god, the rebound is going to be crazy. But if you're going to commit to this, then you need to commit to it long term. Now, again, if there's family issues, if there's other things, I mean, hey, we all got families. I'm not, a butthole, so I'm not going to, if you talk to us and communicate with us, we're definitely will, are understanding. So I always say, nothing's truly set in stone. Everything's negotiable. So let's talk about it. Like after you, like as an investor, like hey, let's talk about it. So long as you're, in communication with us as much as we're in communication with you, and you let us know beforehand or whatnot, then the sky's the limit, and we're super flexible. Now the next steps is if you because I'm not sure if this webinar will be in the data room. So the next steps is to get access to the data room to see, to see all the data, set up a call with myself or Jan. Um, and please just fill out the form that's down here, the jot form, to set up a one-on-one call, an investor call with us. And remember, soft commitments are due by May 24th. I'm sorry, May 28th. All right. So yeah, well, I mean, with all that being said, I think it's time for the Q&A. All right. So let's take a look at the questions.